Morning, everybody. Thank you very much for joining VALUFIN this morning. I am Sharon Constançon, the Chief Executive of VALUFIN, and losing my voice. We are running a series of events at the moment, which are all very technical. They're designed to help the organization to understand their Forex complexities, because it's such a big subject, I've actually broken it down into a mnemonic and to a framework so that we can actually spend time getting to understand the various elements. And we're running these over a period of once every 2 weeks, short sessions covering a different letter of the mnemonic in the framework VALUFIN. And this week we are going to be looking at the L of VALUFIN. This is our third event of the series. And just for your information, these are going to be creating the foundations for a book that will be covering the complexities and the detail of Forex management. So this is the step one of that stage. So we're going to be looking at the technical aspects of the foreign exchange element today. And what we wanted to make sure everyone respects and understands is that invariably in the job you're in and the career or profession you've come through, including accountants, that there is no training in this space and you're unlikely to have come across anything that will support you to understand the value and the complexities of foreign exchange. And if you had, invariably, it is very different one company to another. The markets are complex, the markets are volatile, people give you lots of bad information, bad and not very sound advice, and invariably advice is not tailored to the organization either. So the uniqueness of the environment that you're operating within is where the complexity, in addition, comes from over and above the market itself. So just looking at that in more detail, problem we've got as a result of the lack of training is that people are easily influenced by the incorrect information they might be given by providers of currency. They will provide hybrid products, derivative products, give them fancy names. And really what we've got underneath all of that is high risk because the instrument is not fully understood by them, by you, by the impact it's going to have with market conditions changing. The complexity in the market comes from the instruments, the products, the spot rate, market influences, geopolitical influences, trade-related influences, corporate influence, volumes, all those kind of things are causing a constant change in the market. And we will expect it to go up, it goes down. When you expect it to go down, it goes up. When you expect figures to be good, the market might not respond in advance or overreact afterwards. So it's very difficult to try and know what the markets are doing. What you can do is work out when is it good for you relative to what is happening. And that we can work with, live with, and survive. In terms of volatility, I gave you some ideas a moment ago of the types of things that create the degree of volatility that we have to deal with. And within each company environment, we've got the way they might cost their product, whether there's imports or exports, whether there's any natural hedges, what currency pairs they might be in, what are the credit terms, what's the lead time from order to payment, what are the points at which risk is transferred, how do they price the product to their customer, what's their customer market share. All those things actually impact the foreign exchange decisions that a company is going to take very directly. So to create some form of structure to this process, this conversation that we're having over a couple of months and the book that we are developing, is we created a framework to which we can work to get through all the aspects of the complexity, but also in a way that you can then remember, deploy, know where to go to in the framework if you're looking for further information. All these sessions will be recorded, so you will be able to go back to them at any point in time, and the slides are available. So this makes it easy, gives us the ability to transfer knowledge to yourselves in a structured way that you can retain more easily than if it were done in some other format. So VALUFIN stands for value, assess, learn, understand, find, internal, and new. Now, those appear meaningless to you at this point in time, and I fully respect that. So each stage of it, we're going to go through per session, one letter at a time, and consider today what it is we need to learn. So if we look at the learn stage, or the part that we're going to be talking about now, we'll be covering over the next half an hour all the points that are down on the left-hand side margin. We're going to be talking about markets right the way through to internal accounting issues. The learning aspect is to making sure that we understand what are the influences, what are the things that are happening, what is going to cause us to have a cash flow, what is going to cause us to have risk, what is going to cause us to make a profit, all those things, and also just making sure we understand the opportunities available to us, either for good or for bad. So let's look at markets first. The Forex market is the largest, most liquid market globally. It is massive. It is trading almost 24/7. From about lunchtime on a Saturday, it goes quiet, and we pick up in the Far East markets on the Monday morning. So for about 36 hours, the markets go quieter, volumes are much lower, and your corporate market is not active, and your speculation market is not active. You've just got a little bit of trade going on. The Forex components that you as an importer or exporter are most likely to engage in is the spot and short-dated spots, which we will go through in a moment. The vanilla forward, you might come across options from time to time, and you will have seen and maybe even had contact with a number of the derivatives of the above instruments. So that's what the market brings you at a very high level, very generic level. We'll look at some of the component parts inside that in a moment. Currencies, your major currencies are US dollar, euro, sterling. We also see the next tier down, everything from the Chinese yuan right the way through to the Swiss franc, Japanese yen, various currencies like that. And then for various markets, we have got the African countries, led particularly by the South African rand, being the most liquid of the African countries in terms of funds flow, foreign currency flows. There are some idiosyncrasies in the rand market. So for any of those that are with us from South Africa at the moment, we do have exchange control. And then you have a very high interest rate, which is a commonality across a lot of the African countries, which is why I bring it to bear. Often difficult to get liquidity in South American and African currencies, and often they trade the dollar as a stand-in, partly because of exchange control, partly because of local inflation. There are some alternatives to the standard Forex instruments that we've just been discussing. There is the cryptocurrency, Bitcoin being one of them, for example. There are many others, and there are also crypto assets. We're not talking about crypto assets here. We're talking about the cryptocurrencies. We can get derivatives in terms of the futures market, which can have derivatives as well. We might come across contracts for difference, non-deliverable forwards, non-fungible tokens. There are a number of other instruments that are available, not necessarily ones you would need, but sometimes if you're dealing in a non-deliverable currency, of which we just referred to some of them potentially, and there are some sort of larger markets which still have an undeliverable currency, and how those then are traded with these other instruments. So which are the chosen instruments that I would like us to look at in more detail, the ones that you're most likely to engage in, and the ones that, and I make a point on this, are most cost effective as well. So when traded in a portfolio environment, we create liquidity, we create flexibility, but we're working with the vanilla instruments rather than any derivative thereof. The derivative instruments invariably create an opportunity for higher profit for the provider of those instruments. So we have in our short-dated market that I made reference to on the previous slide, the fact that we have spot, which is today plus 2 business days. So today being Tuesday, we would be trading spot for Thursday. We have Tom, which is tomorrow. Today plus 1 would be Wednesday. And then we have today being Tuesday. And then we have spot next, which in this particular case would be Friday. And that being today plus 3 days. Technically, that spot next is actually also a forward contract. The other two, Tom and today, are often referred to as short date forward contracts. Spot technically being today plus 2 days. The other instrument you're going to use a lot is the vanilla forward, where there is one price set that applies only to the last day, maturity day of the contract. That rate applies. It does not apply on any of the other days, which sets it apart from all the other contracts. We then work with the swap and the rate adjustment processes, which we'll discuss in a moment, to be able to utilize that contract at any other time before or after. We have the forward swap, which is a Forex swap instrument, which is the mechanism that we utilize to allow us to use a fixed contract on a different day. It does create cash flows that work in different patterns to what you might want. We will go through the accounting of that, but also the forward swaps can be handled as rate adjustments rather than with cash flow. Depends on the regulated environment you're in, depends on the provider as to which ways they do it. The standard market way of doing it is utilizing swap contracts, which, as we will see, create an accounting anomaly, a complexity, a nuisance, but it makes technically no difference to the price, the overall outcome of what the Forex is going to cost or receive, depending on whether we're imports or exports. So the currency providers we have are what we might call authorized dealers, banks. Then we have a middle tier market, which could be Forex outsourcers, brokers, and platforms, various other environments that are sourcing information and markets from other providers and are then making it available to you via that platform. How is a trade arranged? We can pick up the telephone, phone in one of those providers mentioned. Many of them are pushing, particularly the banks, globally are pushing customers to utilizing platforms. So go onto the platform, transact sometimes within certain limits of size, or currency pairs, or date durations, but allows you to do the transaction more or less when it suits you. Some of those platforms will operate 24/7, other platforms will only operate during office hours. And then you have the email, which is probably the worst of the three evils, and the one that is at risk of not being timely managed by either of the parties to the email. Telephone being the most specific, most direct at that point in time of getting what you want, but the platform equally, it's instant, you get your rate and you get the deal done. I do warn though, very often those that are working with platforms do see a much higher error rate where the wrong transaction is traded because some of those platforms are not as friendly as they should be. We get the rate as a company. So as a company, we go to the provider of currency and we get given a rate. What's the component parts to that rate? So the component parts are, first of all, the interbank rate, which is the one that you might find on a platform on the web. You might find in the interbank market, which is good for $2 million US, and that is what we call the interbank price. The brokers, if you're working with them, invariably don't have access to that degree of fine pricing. So you might see a pip or 2 or 3 over and above the interbank rate at the point that your provider begins their journey And onto that, they will add the margin, which is their profit margin on a back-to-back deal or a position held, and they will then charge a margin to yourselves. We see margins globally from literally 1 or 2 pips on top of their rate, right the way through to 3-4% we might see as well. If you are operating through something like a credit card, places where there's automatic processing from one currency to another, you can see some very high margins in some of those transactions. It's important to negotiate your margin with your provider, irrespective of whether you work on email, phone call, or platform, because it should apply in all those environments. And you need to make sure that you are consistently checking those margins to make sure that price creep doesn't blend into your rate as easily as we do see it. So we talked a moment ago about cash flows. Cash flows are those that are caused by the transaction. Funds will flow across your home currency or corresponding currency if it isn't your home currency. And you will have the different times that flows might happen before the actual payment receipt or after the payment or receipt actually physically happens. Those 3 timelines, and obviously they can spread left and right of the actual flow of the payment or receipt, put together give you what we call the effective rate. And the effective rate is what is actual cost to company and what is actual income to company as a result of all the transactions that relate to a given invoice. From a Forex point of view, in a company, when we're looking at the business and what reflects in the ledger, a lot of companies will come to me and say, we made a loss on Forex. And my guess is invariably it could be anything is the answer. It may or may not be the loss they think it is, because often it is the accounting for foreign exchange which is challenging rather than an actual business loss that's occurring. So we'll cover that in a bit more detail in the slides that follow. So the impact of foreign exchange is on the actual product that you are selling to a customer, for example. What are the seasons? We work for a company that is in the fashion industry, and their lead time cycle is 18 months. We equally work with somebody who imports products from Europe, working on a just-in-time basis, and the timeline between order and payment can be as low as a week. So you can see some very vast different ways in which Forex needs to be considered based on that timeline, and equally how they have defined what is the benchmark they wish to match or beat as a result of that. The important things you need to look at is how competitive are you in the marketplace? What kind of market share do you have? How do you compete against your competitors on price and on volume and on service? What does your brand look like in the marketplace? How are you perceived by your customers? And in terms of the entire package of the foreign exchange element is the financial viability of getting this product to market at a competitive price. You need to understand the impact of your sales, your products, your imports, your exports in terms of business sustainability. So there's no point outpricing yourself so that you don't survive. It's also equally inappropriate for an accounts department to overprice with a margin in the accounting function, which often happens. We do see anything, typically 2 to 5% comes in via the accounting function, making the product uncompetitive. So you might show a high profit, but that's not the purpose. You haven't sold anything. So you need to make sure you get that balance as to where you get the pricing right and where you make the business profit rather than an accounting entry. We also need to have a look at how are the team incentivized, what kind of things might they do that are unintended and not desirable. Equally, how does that promote them to do the right thing for the business to actually get the sales generated? And often you see sales specials that might be occurring, and that too would have a difference on your foreign exchange. You might sometimes see that you offer a discount for early payment or a discount for volume. How does that impact your supply chain? How does it impact the foreign exchange plans that you need to make based on the fact that the sales special is something that's only come about today and wasn't planned in the budget 6 months ago, for example. So looking at the cash flows, I am going to follow this slide of words with slide of diagram where you can actually look at the numbers and how those work out. So please bear with me, my slides are not big enough to get everything on the same page. So a spot or a short date forward, typically you will see one rate and funds flow at that rate. You do not see two components or three components. In a maturing forward, if we utilize the forward as planned on the day it matures, you will again see one rate, one flow of funds, nice and simple. If we utilize the forward early, we will do a swap contract. So if we did it 2 months early, we'd see the actual payment going through earlier than the contract and having a matching cash flow if we have not worked on an adjusted rate. And we would see a second element of flow of funds on the contract maturity. Extension, for example, we get to the end of the contract term, it's not required yet. There's been a delay in the shipments thanks to COVID not yet having got ships into the right place in the world. And you now need to extend that contract. So you may have a cash flow now at the maturity date of the contract, being the difference between the contract and spot. And then you have a new contract and the balance will flow when that contract matures or is when it's drawn down to an appropriate date. Options, we typically see cash or no cash, but if it's a premium paid option, you will see that up front at the beginning of the contract, non-refundable, that is your cost element to it. And then the option either delivers or doesn't, depending on its structure and the market behavior during the term of the option. We then have a derivative forward, and that's everything from windows, participating, flexible, fully optional, you name it. There are all sorts of different ones, collars, floors, various different ways in which you can structure a forward. Warning, options are expensive, derivative forwards are expensive. And if you're looking at futures, equally, they are not compatible for normal trade, better for commodity contract style trade, because that's what they match to, is to the commodity as quarterly cycles. So if we had a utilization of a contract early, and I'm not going to spend too much time here, the slides are available. But if we had the original contract maturing on the 15th of August at 18.25, and I have used a dollar-rand example, the reason I've done that is because the numbers are nice and big and easy to work with, and the premium and discounts are very evident. And that's because it has a much higher interest rate than the US dollar. If we're looking at sterling or euro and dollar, we have at most about 1%. So it's not as easy to demonstrate the degree of cash flow that might occur. We then have the drawdown to the 6th of July. Funds that go through the bank are 1.7 million, being the current spot rate. And based on that current spot rate, we create an opposite forward to the existing one, resulting in 113,000 cash that will go out in August. Therefore, cost of that import, 1.8 million, 13. So it's not a cost of 1.7, which is what most people will see and assume, and then get excited when the 113 goes out and calls that loss, which is not the case. The outcome to the business overall is exactly the same, but we have reflected the numbers incorrectly, and therefore thinking we're making profits and losses when actually we have just got timing differences. In the case of an extension, which is the opposite way around, we start off with our contract that's due now in June, for example. We now extend that through to a future date, let's say September. We will end up on the day that the contract matures. We've got 80,000 going out in this example, and we have a new contract where we are going to get funds in, because this is an export version. Funds would come in at the end of 1.8 million, but the two lots together actually give us an overall income of 1.7 million, not a loss of 80 and a massive excessive income at 1.8 million, 1,867,000, when actually it's 1.7 million and 87. So these are the kind of timing differences that get in your way. And what I will do on the next slide after this one is I will show what does that do to the entries in the book, so we can see the whole pattern right the way through. We need to understand what is real profit. And real profit is the Forex against what? So we had an actual, in this case, funds that came, that we made a payment for example, and we will compare that against the rate at which we raised the debtor, the costing rate of the item. And the anomaly we have is that costing rate could be any rate. We see all sorts of versions that accountants will come up with as to what that rate is going to be, and all it creates is noise. So it is much nicer to have one rate for the year, make it or break it, change it, reforecast it if you need to, but have some kind of standardized way of saying, I need to get on with my business at a given rate. I need to manage my Forex, but I can't manage my Forex if it prevents me from managing my business. So yes, a rate needs to be set. Changing it every month does create a lot of noise. It does create revaluation entries, and it does make it difficult in the accounting system to understand what was the final cost to company. From our systems, the way we run on our FRM system at VALUFIN, we are able to give you that information irrespective of the noise created in the interim period. But you can imagine having a purchase order that's there for 6 months. There is risk, there is Forex elements to it. And then we convert that into invoices that have got a 180-day credit period. And for 6 months, we revalue that exposure, giving it a new value every month, not knowing actually how that impacts the overall business, because we have priced that to the customer and sold it to the customer already. So you often get back to front timing in a business where the product has been used in manufacture, but we've not paid for it yet. And yet there's a given cost to the company. So it is important to pick up what those rates are, what those timings are, so that you can get to true P&L. And making sure that the most important and the most critical is that when you are pricing the product, the actual income generating part of it for yourselves as a business, that you've got the right rate in there. And if you've gone and put in a rate at sterling at 120 when sterling is 128 today, you're going to get a vast difference in the P&L numbers, but also actually, are you impacting your competitiveness of your business? Are you impacting the pricing at which you are putting it out there into the market? The business profit is the difference between what you earn from the customer and what you paid for the Forex, as an import example. Import goes into manufacture and then goes out to the customer, or straight through, whichever it may be. So that is actually your business profit, something that people don't see anywhere other than it ends up in the GP and ultimately the net profit line of the business, but very difficult to pull out, identify, and manage, which is where having systems like our FRM system allows us to be able to give you that degree of insight. And then you have the other thing you need to measure is, did you do the right thing? And looking back in foreign exchange, you'll always be wrong at some point in life. But making sure that you look at what were the opportunities and decision points available to me at the time I did something. Could I have done something earlier? What could I have done else at that point in time? And what can I learn from that so that next time I do a utilization of a contract, make a payment, receipt funds, that I've looked at all my alternatives. We do benchmarking against 13 different variables, ranging from today's spot rate to what the forward rate would have been had I taken forward on day one that I raised the sales order, or purchase order in this particular case that I'm using as an example. So there's a lot of what ifs, and there's what you see in the accounts and what you know is in the business, and making sure that all of that information is correctly understood. So taking that first example we did a moment ago, where we saw the 113,000 that's going to go out in August, and we had the 1.7 million going out in July. So if you look at that example, a 1.8 million cost to company to import those goods. So the first thing you've got is you are going to be paying somebody for those goods that you have bought, and you will have raised it in one of those many rates that I described on the previous slide. And I'm assuming a rate of 18.75. you put it through, and you now raise that as a commitment and liability for the company. Then on the 6th of July, when you make the payment, what goes through the bank account is the 1.7 million, but that is not the rate, the amount that you put through to the expense that you are incurring to the liability. You put the full 1.8 million effective rate, and the difference you raise to the balance sheet. By holding it in the balance sheet, when the funds flow later on, bottom of your screen, that 113 will clear out in August back to a null balance, and you will raise the correct profit and loss between this chosen rate and the actual rate to the business. This is not business profit, this is accounting profit. So at month end, we revalue, we change rates, we do all sorts of things that create a degree of noise. So if there's a revaluation monthly, we will be raising entries to an unrealized P&L account, one in the balance sheet, one in the income statement. So it's not realized, it's meaningless, it creates noise, but it is a standard practice that we have. And the important thing in your Forex management is knowing where you started and where you finished, with all the noise in between, so that you get to the right accounting P&L, but you also understand the business impact fully as well. There might be I've covered the revaluation, and the other one that gets revalued is if you have any currency accounts that have got a foreign currency balance in them, those are revalued, as well as your debtors and your creditors. At year end, we do exactly the same again, but we add to it the revaluation of the forward portfolio. It's typically not done during the year, but it is always done at the end of the year. And anomalies and number imbalances come from the fact that you may have a strategy and a decision to have taken hedging on some of your sales and purchase orders, not only on your invoices, or which means you've got more on the forward contracts than you have on the liability or the asset. The other side of it is you've got a forward portfolio that at that moment in time is less than your asset or your liability commitment, and therefore the revaluation number, however much you're using a common rate between the two of them, you're not ending up with a profit on the one and a loss on the other that equal nil. Very often these revaluations don't equal nil, and they create a lot of emotion and excitement because they're not readily understood, one by accountants in the profession, but even less by the finance people within the organization or business owners as to what that unrealized revaluation does to the books of the company at year end, because they're directly, unrealized as they are part of the final financials of the end of the year. So it is important to understand them, but you have no control over it. But the rate at year end or month end is whatever it's going to be, and you have no influence over it. All you've got is, if you have a very matched portfolio, you will have a positive and a negative, and the impact on the business is limited. But you can't always have something that is balanced, because your order cycles change, the shipments are changing, products are being delayed, double shipments are happening, all sorts of things in the business are occurring. So the chance of having a perfect match between your liability and your forward contract is unlikely, unless it's a big capex item and you have matched something directly one-to-one, then yes, it will be the case. So we have been through all those elements from markets, alternatives, various instruments available to you, the kinds of ways you can go about doing the dealing, how you understand it's going to influence aspects of your company. You understand now that cash flows will occur, and how do you account for them, and how do you manage them? And it is something you need to understand from a liquidity point of view. So doing a revaluation the previous month on your forward contract, which we do for you, you can see per contract the potential cash flow that might occur in the coming month, assuming the spot rate is still the same, which is an impossible assumption. So it does give you some idea of being able to plan for those cash flows. They do hurt. The other cash flow that can sometimes happen is a mark to market, which we'll cover in one of the other sessions. Also creates a lot of emotion and liquidity pressure. But these cash flows on extensions and drawdowns can be negated by what we call a rate adjustment, and that then builds the effective rate into the deal rate rather than a combination of two items. We have the real profit, we have the accounting issues that we need to deal with, the accounting entries, and we need to deal with month ends and year ends, and we need to understand where that is all reflected in the balance sheet and income statement of the organization. So just in summary, a couple of slides that I cover in each of the sessions, just to pull us back to a common point, is making sure that we deal with respecting that however much the market is common to everyone, you as a company will interface with that market uniquely. And you need to be able to know what you're doing before you make the phone call. All the advice, all the understanding, all the considerations and decisions happen before you pick up the phone, enter a platform, send an email. And then it's about the actual rate itself. And everyone looks at Forex management as managing that rate. But yet, 5 minutes before, that rate was more than the margin away from where it is now. So be aware of being driven by paper, be aware of being driven by falsely looking at an element of Forex management as being the only element. We do see a lot of people that focus on rate only. Please, you need to do what's right for the company first, considering all the influences in the market, knowing what your business needs, where they are in the season or life cycle of a year, and whether you've got a year end coming up shortly, and what is expected the market's going to do as that interface with the uniqueness of your company. So we look at the different elements of the market, which we've now covered that in today's session. We covered the instruments, the time and interest rates we did in an earlier session, and we discussed the spot rate element as well. And we've covered all of those in a bit more detail today. So how do we manage foreign exchange? We need to learn, we need to improve what we're doing on an ongoing basis. We need to have the right information, and with that, manage it to make the right decisions. You can't make Forex decisions on partial information. I used to work for a corporate and expected my bank to give me valid advice, and I used to get very frustrated. I then decided to go to the dark side and went to go and work for Societe Generale as their chief dealer, and realized why it wasn't working, because from that side, I now had identified the customer's multi-banked, doesn't have the resources and ability to record that information that they're doing with many different banks, what their sales orders are, what their invoices might be. And therefore, I was trying to give them advice on limited information, and that was very dangerous. So that's when I started my business of getting between the banks, many authorized dealers, whoever else they might be, brokers, and become the Treasury Department, be inside the organization, be part of the management team, being focused on what's right for the company in that volatile market environment is trying to deal with. So it's very important to make sure that you don't make assumptions. I did many years ago when I thought there were people who could give me the right information. And you need to be inside the business to do that with good Forex knowledge. And those bodies, entities, are few and far between. So we've talked about the spot rates and the future rates, forwards, and all the other elements that we've talked about. We've talked about the risks coming from our providers. We also have understood today how we need to correlate it to the business, and we need to make the right decisions because we have the competencies in the people, and we have the right information, and we know about our company. As a result of that, we have a far better chance of actually recording a business profit on Forex activities rather than not making a business profit and not actually behaving in a sustainable way for the organization. So in conclusion, thank you very much, everybody. We have done this within a 40-minute time limit. I will just check to see if you have put up any questions for us at this point in time. Okay, we have got one question here. It's around what kind of information should I be considering that I need to be able to find, source, and collate so that I can make the right foreign exchange decisions. So thank you, a very valid question, and it will differ company to company, but talking from a generic timeline point of view, you would start with the sales or purchase order that occurs within the business. And actually, from a risk appetite point of view, you're probably looking at what is this business strategy? Where's this business going? Are we growing? Are we buying up other competitors? Are we looking at increasing our product range? Where is the business at? So let's start there, because that will give us a guidance as to whether we've got an increasing element of content to deal with or a decreasing one, or something that is relatively stable. So we need to look at that sales purchase order place, and invariably that is not in the same accounting place that your invoices are. So often this might be in a side system or in a ring-fence part within the accounting system, but invariably there's not a direct talk through to the invoicing part of it at an accounting level. They might be at a process level. So we've got the orders, then we have from there the shipping, transfer of risk, insurance, carriage, journey, and the goods arrive. And we then have credit periods, payment in advance, discounts, deposits up front, all the different ways in which you might need to flow the funds relating to that. Invoices then flow at that point in time, and depending on the terms, so the payment date, receipt date are defined, and you now deal with the foreign exchange on that day as it comes through. So you need to go to the back to a summary. You need to record your orders. You need to record your invoices from the orders, so you don't end up with a multiplying number. Then you need to record the transactions that you do. And the last stage, to ensure integrity of your data and valid transparency and the correct answers, is you need to, at the point of payment or receipt, is to marry the Forex to the invoice and the underlying business transaction, so that you can now get business information relating to that. So you need to bring that marriage together at the end. That is using the effective rate combined with the invoice and what is costed in the ledger to give us our accounting information. We still need to consider the business information, which is one of the benchmarks we do in the 13, because we do look at the costing rate that the company has used as well as the accounting rate that they're using, and reevaluate. So an area of lots of complexity. I do appreciate your time. There is one other question that I just want to pick up quickly. Let's see if it's a quick answer. Okay, thanks very much for that. I have covered the question posed in the answer I have just given. We will be running another session in 2 weeks' time, where we will be covering the U of understand, and we will be looking at another whole package of the Forex complexity area that you're dealing with as a finance director, business owner of an importing or exporting company, whether you are based anywhere in the world, trading with anywhere in the world. Some are more complex than others, but I appreciate you spending the journey with me for the last 45 minutes. And any questions or emails, please contact me. The email address is there on the slide at the moment. If not, you can contact me on LinkedIn. There's only one of me, so I'm easily found. And if you would like further information on VALUFIN or on our sister company, Constançon Currencies, that's in South Africa, you are more than welcome to make contact with us. So thank you, everybody. And I wish you a good day. Thanks a lot.